Good day, traders. I trust you are all well. And welcome everybody, if you're joining us on Zoom or if you're joining via any of the social media platforms, welcome. Well, today is the first Wednesday of the month, and it's been quite dramatic so far in the market. Let's have a look at what we have so far. I'm going to start with Hang Seng 50. By the way, of course, and you have all the links. Next week is the second Wednesday of the month. Second Wednesday of the month. So don't forget to subscribe or register for the second Wednesday of the month, the 4 hours trading the open Asian markets, UK markets, and Europe, US markets. Hang Seng 50 was closed yesterday, and today we opened with a huge gap up. Now, for those who have sat through the Trading the Open course, this would have been a fantastic opportunity for you to jump into the market. So this is a high of yesterday, green line, low of yesterday, red line, midpoint, of course. Measured move is right up here, and the open of the day is the low of that first candle. Now, huge gap up, as we said, bulls in control, they created the gap, and we're always interested in what actually happens with the first candle. First candle, the bulls control the candle, bear candle, trend candle. Bulls controlled the trend candle, closing on or near its high. So very good for the bulls. Created the gap up and still had full trend candle. Now, just have a look at what they actually managed to do. This line here is the measured move, trading range of yesterday. So if the market had opened somewhere down here and the bulls had been pushing the market up, would have said their first objective is to get to a measured move. So at the open with the gap up and the first candle, they go to the measured move and they closed above the measured move, closing on or near the high of that first candle. So very strong bulls. Okay. So the open of the Asian market, as we know, we don't trade the first candle, the open of the Asian markets. We wait and see what other information we can get. Second candle of the day, failed breakout by the bulls. So that was a bit of a disappointment for the bulls, a high test candle. And at that point, you would have said, hang on a second, bulls very strong with the gap up, very strong, the first candle. Why are we failing to get a second trend candle? Okay, so a bit of question marks in your mind. So that's why we don't jump into the first candle on the Asian session, because market could reverse. Third candle, distant enough reversal candle for the bears. And when we talk of third candle trades, that candle would qualify for a third candle trade. However, it's a low probability trade simply because of this huge gap up. Okay, so low probability trade, you should not be taking that trade. However, I'm calling it a low probability trade, which means you could take that trade if you wanted. And if you wanted to take that as a third trade, let's just see, you'd have to put your stop, measured move, okay, of that move that we have. So you'll be taking that trade, and your objective would be, well, if I take that trade, that measured move, I think I can get at least 1-to-1. The market will reverse far enough for me to get my 1-to-1. So you'll be hoping to get down here and get to 1-to-1. Now, the problem you'd have, of course, is the gap up and the rise in EMA, 10 EMA indicator of strength. So if you take that trade, you've got to be in a scalping mode. which means you're very happy to say if the market turns against me, I'll take my profit, whatever it may be, 0.25%, 1%, 1 to 1, and get out of the market. So you could take that trade, open to get here, and then when you see an inside candle, which means the bears had good enough entry candle, very good for the bears, broke beneath the open of the day, and you want the bears to follow through, so at least you can get your 1 to 1. When you get that inside candle, and if you decide to wait a little bit because of the tail and you get that, you must get out. You have to get out of that low probability trade. Because that reversal could be a full candle, get out break even. But if you decide to take a low probability trade, remember you are in a scalping mode, which means as soon as the market turns against you or appears to go against you, you have to get out of the market. I wouldn't take that, but fits in the criteria. If you took that, the problem is you may not be fast enough to execute a proper trade, a higher probability trade. Okay, so the first higher probability trade for the day was here. And if you were to take that, that's the trade you have to take. Reason for it, after this setup for the bears, you would have been waiting as a bull to say if the bears are strong enough to have a follow through after here, they're going to get to their measured move, and it's going to fit one of our strategies, which is a reversal at a level of support. In this case, that will be support. So if you're saying, okay, I'm not taking that, let me wait to see if the bears will give me a reversal here. But the market turned and the opportunity did not come. So after the inside candle, which is a pause for the bears and a failed breakout for the bears, then you get an inside candle. Inside candle breakout mode, you have to take a trade. Okay, that's a trade that you take. And where do you put your stop for that particular trade? Well, already we have seen it. There's a measured move that you could have put your stop on. That's the more conservative stop to put your place to put your stop on. Another place you could put your stop on if you wanted. It's quite aggressive, but it's still a legitimate place. Measured move of the first candle. Okay, because this has turned out to be an attempt to break beneath the measured move of the first candle, and that has failed. So you can put your stop here, put your stop here, more conservatively. At the open, I prefer to use the more conservative stop. That's the best, because things are still forming in the open. Market might come back and try and do one more push down, which would give us, first push down, second push down. Market can do that legitimately and still go up. So I always prefer to use a more conservative stop. So the stop would have been here for that particular trade. Then you take that and then you wait. So if you've taken that trade, the next opportunity, you would have come up here. There is an attempt by the bulls to break out above that high. A very weak breakout. There is a pullback. There is a 2-bar reversal that sets up. So two-bar reversal setup, you could look to take that trade. Now, if you have already taken that trade, you are not at your 1-to-1 yet at this point. Okay, unless if you put the more aggressive stop just beneath the measured move of that first candle, that's why there's that pullback there. Profit taking, guys will put an aggressive stop to take up there. So if you have already done that and you're at 1-to-1, you can take that trade if you want to take that particular trade. If you have put your stop down here, the 1-to-1 is somewhere up here. You do not go and take that trade. So having put my stop here, the more conservative one, I wouldn't take that particular trade. And again, if you got the scalper's mentality and you put in tight stops in, you can take that trade because that's rated 1-to-1 and see if you get more. But my kind of unwritten, unsaid rule, George said often, is there's no need to trade with stress. There's so much opportunity. And I'll show you just how the market set up so far this morning and the opportunities that were there. So you could have taken that trade again if you've taken a tighter stop. If you've taken that earlier trade, you wait, you get the breakout attempt above the measured move. And that's where we're looking to see if there's a second opportunity for us. So that's a test of the measured move of that first move that we had, first candle and then the pullback. So breakout, and then we come back and we get a second reversal, one of the stories we spoke about. Breakout, attempt, first reversal. We don't take that. Let's wait for the second reversal as support. I mean, this is probably as classic as it would come. A test of the 10 EMA, which is an indicator of the strength of a trend. An inside candle, which is serving as a 2-bar reversal. I mean, it's pretty classic at that point. That's a trade you take, and you can put your stop beneath here. The reason you can do that is because it's a second reversal. If you're taking that first reversal, okay, which is not part of the strategy you're trading at the intermediate level, then your stop has to be here. And the reason for that is that you're taking a first reversal. There might be a second reversal, there might be a third reversal, which could be a wedge. You have to put your stop here. But if you're taking the second reversal, put your stop beneath here. That's a good place to put it. And if you want, so you can put it beneath here. Hong Kong, I just say minus $10 on the low. And that's where I put my stop. But if you wanted to be a little bit more conservative, measured move with a 2-bar reversal, still down here, that's a fair place to put your stop. And remember, again, I must say this up front, there's always 2 ways to manage your trades. Either you set them to take your profits at the next level of markets going up, next level of resistance at 1-to-1 at least, or you manage your trades. In other words, you're going to be trailing our stop up and just seeing how far the market goes until we see a clear reversal. When we see a clear reversal, then we can come out of the trades. Okay, what I just want to show us very quickly, I'm coming back to this. So Hang Seng 50 no setups at the moment, so we're not missing much at the moment. Probably should have done that a bit earlier because I've been in the market and kind of get a sense where things are. Let's do that quickly. S&P 500, we'll come and talk about the charts, but at the present moment, there is no setup for us. We've just had this double bottom, lower low, double bottom, few candle separation, so we don't want to take that. If we get a lower high, market pulling back and giving us a higher low, we're going to look to take a trade. But we're in a major trend reversal setup, which is one of patterns we look for after a trade. UK 100, again, if we get a chance to talk about this just now, but again, we are in a reversal pattern with a double bottom, good acceleration up by the bulls. All we'd want is to see some form of a higher low, then we can look to jump into the market. German 30, again, a little bit more complex to trade earlier on, but we'll look at that again. Again, we're in a reversal pattern, which is a trading range. Remember, we're trying to get into these reversals into trends as they are unfolding, so we can get as much profit as possible as the market moves into the trend. Euro has been good in terms of selling off. I think after Hang Seng 50, I'll come to Euro and just talk about what took place here. Very interesting pattern. It's interesting, isn't it, that the market is sold off, which is what I've been speaking about, that the bull candles that we had, it's just a pullback. So far, the bulls need to do a lot more to turn the market. And Euro is pretty classic so far. And I'll jump to Euro after Hang Seng 50. But with Euro, getting to the measured move, lower low, double bottom, bit of a range. I'll talk about it. There is nowhere to jump into a trade at the present moment. Let us see it falls in gold for those who are in gold. Interesting enough, last weekend's gold kind of explains or shows a bit of what I'm talking about. We go to a measured move, lower low. So if you kind of thought, hey, it's been selling off, let me jump in, you'll be in trouble at the moment. Because now we are in a reversal pattern, but we'll talk about that. Let's just finish off Hang Seng 50 and get to Euro very quickly and see if let's talk about that. So yeah, that would have been a perfect trade to take. Again, we had an attempt to break out above the previous high, breakout pullback. That two-bar reversal, another setup to take. Now, with this one that you're taking here, if you just look here, first opportunity, which we said you would take the stop down here, but this is the best setup as part of our strategies that we've spoken about. Reversal at the EMA, the second reversal. First one, second, stop here. When we get to this one, this is the first reversal after the pullback. Okay, so if you're taking the first reversal after the pullback, you don't put your stop here. So the stop has to be down at this level, the previous low or down here. Okay. Now, within this pattern, again, we get another opportunity here to get into the market. And again, you don't put your stop here, you can put your stop here. Now, if you're taking any of these trades, you just take one. These are all within the same structure, if you like. You're only taking one. If you miss this one, you wait, you take that one. If you miss that one, you wait, you take that one. If you've taken that one, you don't take that, even at 0.25%. We do not do that because we want to give this trade an opportunity to work and get to one or more. In any case, we then got to what was the low of 2022 since March. So it was a key level. The market starts to go sideways. At this point, the market is going sideways at a key resistance. If you have not been taking your profits at 1-to-1, close your trades, bank your money, and wait to see what happens the European and UK markets. So pretty, if you're in the market, if you're not in the market, this is a good chart just to save. Save as a picture, make your notes, because this fits in well with the strategies that we covered in our recent course. Let's jump to Euro versus the dollar. Now, the other thing to bear in mind, we've got news announcement coming in exactly 2.5 hours from now. And it's pretty significant news, red news on the ADP non-farm payrolls, and that tends to move the market quite substantially. So you want to be out of the market early unless you're already in trades. So just be cautious about that. Euro versus the dollar. On the open, doji candles, that gives you information. Remember, every first candle of the day gives us information. Doji candle, log test, small bull candle, bull slightly in control, but trading range price action. Second candle, again, doji candle, trading range price action. Then we get a 2-bar reversal. Already we get information that we can expect a trading range in the first part of the day, which is what we eventually got. We got a trading range. Now, could you have traded here earlier on? We could have taken that trade. I didn't mark that particular trade because at that point you don't have all of this. Okay, it's a decent enough setup, but you are selling straight into that low of the day, not much for one-to-one, so leave it. There's no need to take that, or just wait and see if you get a little bit more information. Now, let me just go to the daily chart for you. I spoke about this in TTR first Sunday of the month. Also a little bit when I was a guest in my buddy's show, Trading Buddies. This channel here, this channel has dominated the market virtually for the whole of this year. It started in February, but you can see January itself kind of went sideways, high, low, and back to test, so trading range. But we've been in a bear channel as far as euro is concerned. And when we were down here, my sentiment was, well, as far as the bears are concerned, they're not going to fuss too much about the market turning here because it's low of a channel. We do expect that when the market gets to its low, there has to be buying because it's in the channel, and their interest would have been and is at the top of the channel, this descending trend line here. That's the interest. That's what they would have been looking at to say, well, let's see what the market will do. Let's move it out a bit. So if we connected that high and that low, that's how I do the channel line, and then just pulled it down. You can see right at the channel line here, market went sideways, and then bears took control, tried again here, went sideways, tried again here, sideways, bears took control, tried here, and huge bear reversal. Again, there is an attempt here by the bulls to break out above that channel line. Now, if the bulls are strong, I mean, we only halfway through the actual full day, so there's much opportunity. And it could happen today, it could happen tomorrow. If the bulls are strong, the bulls want to make sure that today does not come and close beneath this level, this level was a breakout point for the bears, that low. Bears broke out here. Bears will defend that strongly. And how will bears defend it? Bears just want the market to close a bit below this. Then they can say, oh, we control, this is just a lower high, let's keep selling. Yeah, but bulls don't want that. Bulls would want, if we come down here, they want to bounce off this level, or they want to turn the market exactly where we are and buy into today, and hopefully today will just end up as a tail on the day. They will have to close above the bear channel. They will need to close above this previous lower high where the bear breakout started. And if they do that and hold the close above here, then they have an opportunity to break the market structure. And the market structure is defined by the bear channel, so you can't ignore that. So you just leave that on your charts. And when you come to the day, this is what the day looked like. Okay, so the day is unfolding. This is a high of yesterday. There is the bear channel line coming down. So you would have seen all this price action at the open of the European market. So what we saw at the open of the European markets, dodgy inside candle, bulls trying to stop the bear momentum. Okay, and they did, because that inside candle, the dodgy candle, paused the market. And you kind of would have thought, well, if the bears were strong, we should just carry on selling. But they didn't at that particular moment. The market turned. And at the open of the European markets, there wasn't any decent entry for us. We would have loved a beautiful, a bull low test candle. In other words, this kind of candle, but inverted with the tail at the bottom, would mean that the bears try to sell off and they feel the bulls control. Then that would have been a decent enough buy to take. But as it is with the tails on top, low probability trades, you don't want to be jumping into low probability trades at all. And bear in mind also, we've got at this stage, you've still got the UK markets opening pretty soon. So best to let that go and wait to see. You've got your open of the day. You've got this double top, which was the high of the Asian session, extended out, and you've got the channel line coming down. You've got the high of yesterday. So bull acceleration, and we get there. And if you look at this huge bull candle, failed breakout above the double top of the Asian session. Second candle, an attempt by the bulls to accelerate up, and then they immediately fail. Now, that failure at this level, there are three, call it four confluence factors creating a confluence. One is the open of the day. Two is the double top from the Asian session. Three is the descending channel line. And four also, if you have a look, market went up, market came down at the open and then turned. So at the open of the European markets, we had the market turning and a small trading range created, and the bulls wanted to get to a measured move above that. So again, if you're in the scalping mode, just jump in and scalp and be prepared. Well, scalpers don't have to be prepared to exit. They just exit. That's how they think. So, and they would have said, well, if I get to a measured move, I'll take my profit. Market got to the measured move of that trading range, the nearest trading range. So all of this is profit taking by the bulls. It's bears trying to reverse the market at resistance, and you get a decent enough entry, reversing candle. That's a trade that you would take. Taking that trade would stop it off to get a measured move. Okay. Now, how does it fit? How does this fit into our strategies that we have spoken about? So, firstly, it's a reversal at resistance levels. Clearly, so that's a big tip. One of our strategies is a reversal at resistance levels. But we said let's look for at the open, we want to find second reversals. So there is the open, and the first opportunity for us to have tried to sell would have been below this candle here. Okay, if that had accelerated down, that would have given us another opportunity, but that did not materialize. But it is technically the first opportunity, did not materialize. Then all the way up here, there was not a single candle that went below the open, went below the low of the previous candle. So nor did we have a bear candle in all of this until we got to the level of resistance. And then we got that reversal and that opportunity. Now, if you didn't compute all of that and you didn't see that and you saw all of this and you said, my goodness, this is a strong bullish price action, and assume you hadn't had the bear channel, you know, maybe you haven't had the double top and all you could see was the high of yesterday, and you saw that setup and you said, hey, I'm not quite clear, I'm not going to take the setup. That is perfectly fine. You don't have to take that setup. Then you have to wait and wait for another opportunity to come. Now, the next time the market presents an opportunity is at the open of the UK markets. There is the open of the UK markets. Bears broke out. It was bears selling off. And then they failed, bull candle. Then when bulls went up again and market failed. Okay, so I don't know if you can quite see the yellow candle, but that candle there was the open of the UK market. So came up, market closed, opened, huge bear candle, failed by bulls coming back into the close. And whether they went up and came back again, the bears controlled the candle, but the huge tail was the reversal that was contained within this one candle. Then the bears started selling off again. Now, taking that trade with these lows here makes that a low probability trade. If you want to take that trade and you say, okay, the bulls have accelerated, the bears have accelerated down, again, I'm going to take a trade here because I now see what's taking place here. And if you break beneath here, there is a measured move. So there's a measured move, that high and that low. If you want to take that trade, remember the constraint that you have is where to put your stop. So if you take that trade, it's a low probability trade because you're selling right into levels of support, but it's at the open, and you can put your stop here and be prepared to say, well, if it bounces off here instead of giving me a measured move, I will just come out of the trade with a small loss. So that's a trade you could consider taking. I wouldn't take it because of it's a low probability trade coming up to this level of support. The only way that I would consider taking this trade, remember, if you go back to our strategies again, that's the first candle of the UK session. If we'd had an inside candle, and it's a bear candle, okay, and it's closing within this candle. So let's assume this candle here was an inside candle closing within the first candle. Then if you go to our notes for the course, we talk of second candle trades, and we specifically say you can take a second candle trade at the open if the second candle completes the first candle. So that would have been a perfect trade if that had set up there for us. But it didn't set up, so low probability trade coming up. If you're prepared, put your stop here and hope that you get a breakout and a measured move, which we managed to get. If you had missed that and you said, oh man, I didn't take that trade, and low probability, I didn't take that trade, but now when you see this pullback, okay, here is a breakout, here is a pullback, now you have a distinct possible measured move that you can aim for. There is a measured move. Then you're going to look to find ways to jump into the market. There's two ways you could have got in. One, beneath this bull candle, okay, decent enough. Reversal, it's a bull candle, bulls controlled it. So we know that bulls are still in the market, and we never put our stop here. In any case, we have to put our stop just above the open. That's probably the best to put the stop. So there'll be no problem taking that trade. If you didn't want to sell beneath the bull candle, you wait for the bear candle. Now, what you are trading into is the measured move. You're hoping to get to a measured move. So you could take that or take that trade and get here. You can see this reversal. This is profit taking. Guys said, okay, reach the measured move. Bears are out, taking their profits, they're gone. So that you could do. If you didn't take that trade and you saw this breakout pullback, first reversal, leave that. Wait to see what happens at the EMAs. We get another near perfect opportunity to take a trade. So when the market is like this, you really got to optimize the opportunities. By the way, if you've taken that trade and banked your cash, you can take that trade. If you've taken that trade and not banked your cash for any reason, hoping to get further acceleration down, you don't take two trades at the same level. Okay, so this trade and this trade are the same structure, same trade. You only take one. If you bank your money by here, you can take this again. If you haven't banked your money, don't go and take three trades. You just take one in this particular area. But that would have been a perfect trade to take. Stop, measured move, just above here. That's the conservative stop to put in. You can put your stop above here. Okay, because that's the second entry. There's a first entry, there's a second entry. You can put your stop above here. And your goal is to see if you get to this low. And even if you had missed all of this action here, if you just came back and just took that trade and say, okay, man, all of this has been unfolding pretty quickly for me. Yeah, maybe I could have taken that, but I didn't. But now this is cream, this is gem. if you did that, just that alone, with a conservative stop, 14 pips, 22 pips, 1-to-1 quite easily. Just took that, and if you took that, the tighter stop, call it 10 pips, then 2.1-to-1. And remember, if you have not participated in all of this and not banked money, the other part of our strategy is our capital allocation and capital management. How do we allocate money from this pot of cash that we have? Remember, I said the very first trade that you initiate for the day on any market, forget about what you have banked on Hang Seng 50. So I don't even worry about what I've banked on Hang Seng 50 if I'm now trading euro versus dollar. It's this market I'm concerned about. That's how you manage your capital. First trade is 0.25. So even on that, on 2-to-1, we will bank 0.5% already, or just 0.25, put your stop here. On one market, one trade, early in the month, this off came. However, if you had banked all of this, I think you would be quite comfortable with the week. Let's have a quick look at gold. Okay, so gold, let's look at the European Open bear candle, market with a double bottom. So the channel selling off, so wedge bottom, first there's 3 pushes down, 1, 2, 3, that's a wedge bottom. That first low, these constitute one because there's not much separation between them. And there is another one. Would have loved to see a decent enough candle for us to jump in here, but we didn't get. So low probability trading, which you don't have to do. There is always so many opportunities. Then market breaks off. We didn't get this on the euro. There is a first attempt to reverse. Okay, so looking for our kind of trades, opening reversal, and you're looking for a low 2, which is a second reversal. There is a first reversal. Market broke beneath its lows, but we got bull candles, nothing for us to sell here. But we can see, okay, the bears are strong enough to be able to stop the momentum of breaking beneath the lows of 2 candles. Let it go. Let's wait for the setup. Then we have the present open of the day. We have the high of the Asian session. That's high there. And then we have this key level. This illustrates one of the things we mentioned in the course. We always look to see if there are any key levels of resistance and support that was established in the US session, the last part of the US session, so yesterday. So that level is key. The market notices that. So the bulls were trying to break out above all of this, above the open of the day, above high of the day so far, Asian high, above this level. Then they wanted to attack the high of yesterday. But they failed, strong reversal. So that becomes our second reversal. Reversal at a hidden level of resistance, being that measured move. So there's actually 4 again. So there is that low and that high trading range. And if the bulls break above that trading range, when they get to a measured move, there is a measured move. They fail to break above the measured move. That's the hidden level of resistance. They failed to break above this key high from the US session. They failed to break above the high of the Asian session. They failed to break above the open of the day. Strong reversal by the bears, and you can place your order there. Now, big caveats, talking about stops. I think you probably, now George is going to talk about a measured move stop at the open. I'm going to talk about a measured move stop at the open. Let me explain it fair. So we always put measured move stops when we're taking a trade at the open. Okay, that's because the market, if you look at enough charts, there is a high probability the market might want to do a double top in this case, come back and test that, or it might come back beyond the double top and go and test that high, which becomes a wedge top for us. Because we are at the open, we are not yet in the trend, so we're taking reversal trades. Huge profit potential, but also only 40% chance of success. You must always bear that in mind. So you put your stop at the measured move in taking that trade. The other reason for it, especially in this particular case, we are going straight into the open of the UK markets. And this candle here that I marked in yellow, which I hope you can see. Yep, that was the open of the UK markets. So you're going straight into that. The bulls at the open, I mean, you see this kind of candle here. They can create that candle. It doesn't mean they're strong. It's just the open. The market does that at the open often. It could be a huge bull candle. So if you put your stop here, you get stopped out. And then the next candle is a big bear candle. You're like, what happened? Well, what happened is that at the open, you decided to put a tight stop. You must always just look to the left and say, I'm going to put a measured move stop. This is a pretty decent one. Went up, came down. Put my stop at there, 0.25. If I get this huge candle stopping me out, then the market resumes again and gets a low high, I jump into the market. Okay, and your objective is to get to this low and hopefully get a breakout to a measured move. That high, that low. Now, something to quickly mention. We've taken the trade, bears and control, UK open, bears still in control. Yes, there is a tail at the bottom, but we get a decent enough follow-through candle, dodgy follow-through candle. So this is a bear breakout, which is going to test the low of the day. At this point, you've got choices again. You can say, okay, I'm here, I'm going to take my profits and go away. Or, as George keeps saying, just try and manage your trades and see if you can optimize profits. If you get a bull candle, you can always close your trades with banks and profits. That's perfectly fine. But when you see a tight trading range and the market is showing bear strength, at least hold on to your trade and see if you get a breakout beneath the tight trading range. Because this trading range could just be a pullback in what becomes a leg one, pullback leg two. So if we were to use our extension tool, so that becomes the first leg, and that's height of a pullback. So let's go back a bit. Okay, we've used this Fibonacci expansion lines. So this tight trading range here, ultimately became just the pullback. First leg, pullback, second leg. I mean, classic pullback that we all recognize would have been first leg, goes up and tests EMAs and come down. But the tight trading range to the EMA is still just a pullback. So if you saw that and you hadn't taken a trade there, you can comfortably take a trade there. And this time, just put your stop above the tight trading range. And you're aiming to get to the, leg one, pullback, leg two. And there you can see all that profit taken is because of traders who are taking profits at the leg two. So take your profits. If, again, you want to hold on and manage your trades, holding on and managing your trades just means you just need to have a strong psychology because you've given up some profits, anticipating that there's a little bit more. This is a legitimate place to take your profits. But if you didn't and you get another classic reversal pattern, it's not at the open now because we were into the trading, but it's one of our strategies. It's a second reversal of an EMA, decent enough two-bar reversal. You can put your stop above here, above the measured move, and you aim to get here and you're able to get one-to-one, but you're rewarded with a breakout and you're able to get out. Even if you didn't get out, you get out here, you still have made your money. All right, guys, so plenty of opportunities. And if you just trade the strategies that we spoke about in our course, you will be on your way to get some good returns for the month. You don't have to do anything else, and you don't have to take all the trades. Thank you very much. And remember, the second Wednesday of the month, next Wednesday, 4 hours, 1.5 hours Each opening, Asian session trade the Hang Seng 50 open, we trade the European UK open, and we trade the US open. 4 hours live in the market. See you then. And Marlon, thank you very much for hosting the meeting. Take care, guys. Bye-bye.